When it comes to investing, there's this one word that seems to capture all the fear and all the opportunity in the market: volatility. Today, we're going to decode what it really means and go way beyond the headlines to see how traders actually use it to their advantage.
You've for sure heard this term splashed all over the news, right? Especially when the markets get choppy and things start looking a little unpredictable.
But here's the thing. It's so much more than just a buzzword for a shaky market or a gut feeling. Volatility is a real, measurable metric that traders rely on day in and day out to make their moves.
And getting a handle on its two main forms, one that looks at the past and one that tries to predict the future, is absolutely essential if you want to gauge risk and, more importantly, spot potential opportunities. Okay, let's dive right in. And to do that, we're going to start by looking in the rearview mirror with something called historical volatility.
Now, as the name kind of gives away, this metric is all about the story of where a stock's price has already been. It measures the actual, real ups and downs that have already happened.
It's a hard number, not a guess. It's calculated by crunching historical price data, usually using the standard deviation of price changes, to get a clear picture of how much the price has jumped around. It's pure, objective data about what has already happened.
And honestly, that's the perfect way to think about it. An almanac can't promise you it won't rain tomorrow, but it gives you a rock-solid, fact-based idea of what's normal for this time of year. It sets your baseline.
Okay, so that's the past. But as investors, what we really care about is what's coming next, right? For that, we need to turn to the forecast, implied volatility. Now, this is a totally different animal. Unlike historical volatility, this isn't based on what's already happened. Nope. This is the market's collective, real-time prediction for the future, and it's calculated directly from the current price of options.
So how does the market come up with this prediction? Well, it all boils down to the buying and selling of options contracts. See, options are basically bets on where a price is headed. So when traders expect big swings, they start buying up options like crazy. That huge demand drives up the price of those options, and that in turn pumps up the implied volatility. It's kind of like the market's fear gauge in real time.
And this just hits the nail on the head. A weather forecast isn't always 100% right, but it's the best information you've got. Implied volatility lets traders put a price on the potential for future moves, and that potential itself becomes something you can trade.
So, we've got the historical facts, and we've got the market's forecast for the future. So what happens when we put them side by side? Well, that's how a trader really starts to see the whole picture. It really all boils down to this one simple difference. Historical volatility is descriptive. It tells you what happened. Implied volatility, on the other hand, is predictive. It's the market's best guess about what's going to happen. One is about what did happen. The other is all about what the market thinks might happen. And believe me, that distinction is everything.
Just look at how different these two are at every single level. Check out that data source row. Historical uses old stock prices to measure what was real, but implied, it uses current options prices to gauge what people are expecting. They're just fundamentally different tools measuring two totally different things: reality versus perception.
So why should you care about both? Because this is where it gets really good. The smartest traders don't just pick one. They find their edge by comparing the two.
This is the absolute core of the strategy. You start with the almanac. That's your historical volatility, to figure out what's normal for a stock. Then you look at the forecast, the implied volatility, to see how the market is feeling right now. It's a pretty straightforward three-step play. First, what does history say is normal? Second, what is the market predicting today? And third, this is the important part, is there a big gap between those two? Because that gap, that's where the opportunity is hiding.
And here's the strategic payoff right here. When implied volatility is way higher than the historical average, it means options are expensive because fear or excitement is high. That can be a great time to be an options seller. On the flip side, if IV is super low compared to the norm, options might be cheap, creating a potential bargain for buyers.
So look, if you walk away with just one thing, let it be this. Historical volatility is the fact-checked past. It's the almanac. Implied volatility is the educated guess about the future. It's the forecast. The real magic, the real insight, happens when you put them side by side. And that last question is the key to this whole game, because the market's guess can be wrong. And that possibility is what drives everything, creating both the huge risks and the incredible opportunities that traders live for every single day.